Have you heard of the news like the Fed hiking its interest rate by 75 basis points and so on? Just as the news pops, or simply when there are speculations about such rate hikes, do you observe that the global markets dip? The effect is just cascading, and each of us as an investor gets affected. Ever wondered what in the world this Fed is and what these rates are? Ever wondered how the US federal system spells a greater impact on the whole world with its policies and why Fed is the one driving this bus? If you want to decode these terms and get a hang of such concepts in simple terms, then this video is for you. What do you understand from the word Fed? Your guess must be it's federal bank or something like a central bank in USA. Well, you are right to some extent. But let's understand that federal bank is not one single bank in USA that sits on top of the other banks to issue rules and guidelines. Fed is actually the Federal Reserve System or the central banking system of the United States of America. This is actually a system of banking. This system was created in 1913 with specific purposes, which we will discuss briefly as we go. Well, this Federal Reserve System comprises several layers, the complexities of which we are not going to discuss. Just take it for now that the Fed is a banking system established in 1913 with specific long-term monetary objectives in mind, and that it has a board of governors. It also consists of 12 Federal Reserve banks located across the nation. These 12 banks actually oversee the other banks. Very important to note that there is a committee that sets the Fed rate and makes all the policy decisions. And that committee is called the Federal Open Market Committee or FOMC. That meets 8 times a year to make these decisions. Well, that's just a basic overview of what Fed means. Now for the big question, what is Fed rate? Banks take deposits from customers. Let's say we have two banks here, Bank A and B. Bank A has collected a total deposits of, let's say, $100,000, just as an example. Bank B collected a total of $150,000. By law, banks are required to maintain cash as a reserve. Just in case any of the bank's customers need to withdraw some money suddenly, or the bank needs to lend extra money suddenly to a business for its development plan, etc. So, for whatever reason, if the bank needs liquid cash, that is, the actual physical cash for its customers, the bank should be able to pay its customer. So, it should have this amount as a reserve. How much amount the bank should have as a reserve for its customers is decided by the Fed. So let's just say in our example, the law is that the bank should maintain $125,000 as reserve. So in this case, Bank A is running short of $25,000 to meet its obligation of maintaining $125,000 reserve. Bank B, on the other hand, is having an excess of $25,000 over the required reserve requirement. So, Bank A borrows $25,000 overnight from Bank B at an interest rate, let's say R, to meet the reserve rule. Now, it's obvious banks don't want to maintain excess reserves because just holding on to cash without lending it is useless, because just cash on hand earns no interest and cash loses value over time. So, banks just want to maintain enough reserves to meet the obligation. Now here, look at the interest rate R. That is the rate at which one bank which is deficient in reserves borrows money from the other bank which has excess of reserves. This rate R is called the Fed rate. As simple as that. Now let me add just a few more details. When we say reserve is nothing but cash, we are incorrect. Reserve is actually the vault cash, meaning the actual cash the bank maintains on hand for its day-to-day needs of dealing with customers, and also the balance in its account with the Fed Bank. Alright, let's just summarize this section that Fed rate is the rate at which banks lend each other money overnight to maintain reserve requirements. So, what happens if the Fed raises this rate? How are you and me affected? Let's dig deep. Increase in Fed rate means the rate at which banks borrow money from each other for their reserve requirements. That rate of borrowing money increases, which means banks have to pay more now to borrow money, which means this money the bank has is now more costlier, which means it has to charge more to the customers who are willing to take a loan. So essentially all our loans become expensive. Credit card, student loans, car loans, house mortgage. Same thing applies to businesses. Their cost of borrowing money increases, affecting their financial health. So the stock market sentiments are also not healthy. Cash is now more important to banks than ever. They want to hold on to it, so they encourage more deposits from customers by offering attractive term deposit rates. People prefer holding more deposits attracted by the bank deposit rates. When people put more money locked in banks, they naturally have less money to spend freely for their wants. Simply put, less money in the system means less inflation. So I hope you see this cascading effect, how Fed rate hike is an attempt to control inflation. Fed rate hike also has a profound effect on the other nations, their policies and the currency exchange rates. This is an extension to this video. So if you like more of this content and how Fed rate affects the global economy, like this video, subscribe and leave me a comment so that I can make another video.